Currents we got to sort out. Yes, the Dow's up 55 points, but you know what? Let's bring in some of the pros who can help us figure it out. On the technicals, we're joined by Larry Shover. He's Chief Investment Officer at SFG Alternatives out in Chicago. Always good to have you, Larry. And on the fundamentals, right here we have in our studio John Carey, Portfolio Manager at Pioneer Investment Management. John, let me start with you. You're the guy with the most money in the game, I believe about $200 billion under management over at Pioneer. What do you make of the fact that we're at 5.5-year highs on the S&P right now?
I think there's still some good bargains out there in the market, and people are slowly getting more comfortable with owning equities. At the same time, there are some macro concerns, which you've noted, some near-term economic concerns as well. With the tax increases, consumer confidence has taken a hit. I think that short term, though, I think that as the economy continues to grow over the next couple of years and housing prices strengthen, people will regain confidence and continue investing in stocks. Great dividends available, terrific balance sheets, lots of worldwide growth opportunities.
Yeah, there certainly are. We're going to get some of your picks, but first I want to ask Larry Shover. Larry, hey, good seeing you. Always enjoy your perspective. I'll ask you the same question. With stocks at 5-year high, 5.5-year high, are you buying right now?
I am buying right now until further notice because, you know, let's face it, we're in a multiples market. And as I said last week and the week before, the market's assuming a 14 times earnings per share. The top-down number is $107. People are starting to get a little bit more cozy with a higher number given the revenue and earnings per share beats. So that might get the S&P 500 up to the 1550, 1570 level a lot sooner than most of us have thought.
Hey, Larry, what's the risk right now that that both you and John are wrong and that we see stocks trade lower?
Well, the big risk to me is what we don't, talk about very much, and that's the downgrade of the U.S. is not off the table right now. I know it's on the back burner, but it's definitely not off the table. I mean, they have 5 weeks to negotiate something, and if that doesn't materialize, I do think we could drop pretty far and pretty fast. But that's the big risk that not a whole lot of us are talking about right now.
No, certainly not, but with good reason. Look, 69 times since 1960 they had up the debt ceiling. They've done it each of those times. John, do you put any credence in the notion that maybe there's a downgrade out there?
I tend to think that we've seen the downgrade, and going forward we'll get on a better footing, I think, budget-wise, and the economy, as long as it keeps growing, I think will restore some of the money to the federal coffers that's been lacking over the past few years. We'll see. Time will tell, but I think the stock market is very interesting if you have a long-term point of view right now.
Hey, autos and housing, two sectors that have started to percolate. What's going on there?
Demand. There was pent-up demand for autos, and with respect to housing, of course, there was such a severe slump that it was just a matter of time before we began to rebound. But we're still in the early stages of the housing recovery, and I think autos have another couple or 3 years of relatively good sales ahead of them. One of the concerns in the market was revenue growth. Would companies be able to grow revenues, or had they achieved all of their earnings advances from cost cutting? And I saw this morning that about 2/3 of the companies reporting for the fourth quarter so far have exceeded revenue growth targets. So that's very positive.
Hey, yeah, that's a big deal. Usually people focus on earnings. And of course, as you know, being a money manager, earnings can be manipulated in any number of ways. But top line growth, just money coming through the door, you can't do that. Hey, Larry Shover, we've got an FOMC meeting that is happening right now. It's a 2-day meeting, so about 2:30 tomorrow we'll get announced, actually about 2:15 New York time. What are you expecting?
I don't expect much of anything, maybe just a little bit of acknowledgement that global growth is expanding just a little bit, but it's going to keep the same levels. Our unemployment rate's still too high. Our inflation level is in check. They're going to keep the foot on the gas pedal for a while. I'm expecting a little bit of substance, not a whole lot of form.
Hey, that being said, what do you make of the bonds? The 10-year trading up around 2%. We haven't seen that number in about 7 months.
Yeah, I think it's a fantastic time to buy the 10-year right now. I do believe we saw a big oversold condition starting on last Friday. I mean, yeah, let's face it, 10 years are rich in a macro perspective, but short-term, probably a really good time to be buying. I think the 10-year should be about 160, 170. So all indications are oversold condition and probably should be buying it.
Hey, John, you really run the whole gamut from stocks to bonds to commodities. What's your take right now on the bonds?
I think there's still some value in the below investment grade area. Be careful, though, of course, about balance sheets and growth prospects for the companies, but that's where the yield advantage is right now. A little bit more difficult in the investment grade bond area, especially in the treasuries, although for security, those investments still make sense for a lot of people.
Yeah, and spreads, by the way, extremely tight. As a matter of fact, yesterday, the yield spread on high yield set a new all-time record. It's that tight, yielding about 5.6%. In that environment, John, it's tough for banks to make money. Obviously, spread compression. What's your take on the banks right now?
I would be focusing on some of the regional banks that have opportunities to grow lending with the improved housing and auto conditions. I'm still a little bit cautious about some of the so-called money center banks, a little bit difficult to figure out how they earn money, and there are still some residual liabilities from the subprime meltdown, but they too should have some earnings recovery over the next couple of years. And the financial services group in general is of interest to me because of the prospect for dividend increases. Historically, that was an area where you could find a lot of good dividends, but after the subprime meltdown, so many of the companies had to cut dividends that the group no longer provided very much in the way of dividends. But dividends are coming back there, and I'd be watching for income opportunities within the financial sector.
Yeah, and there's certainly plenty of dividends on the REITs. Maybe we'll talk about that a little later in the show. All right, our thanks to Larry Shover, the Chief Investment Officer for SFG Alternatives, joining us as he does always from Chicago. Great to see you, Larry. And, of course, our Portfolio Manager, Pioneer Investment Management, John Kerry, who is staying with us through the whole hour. So I tell you, let's try to wrap this up. Here's what you need.